Aloha students, welcome to the lecture on Chapter 2. In Chapter 2, we're going to be looking at a couple of topics. One is cost behavior. So how do costs behave? This is a concept of variable cost, fixed cost, and mixed cost. We also have a couple of ratios that we're going to be calculating. We're also going to be looking at contribution margins. And then finally, we're going to be looking at predicting future costs. Okay, let's first look at fixed costs. So fixed costs remain the same regardless of volume. So when the activity goes up, when the activity goes down, fixed costs are costs that stay the same. So example they use is a concert. So the band's going to be paid $48,000, and regardless of the number of tickets sold, the band will still be paid $48,000. That cost is fixed. Okay, so that's a fixed cost. So again, it remains the same whether it increases or decreases. On a per unit basis, though, fixed costs go down the more activity you have, and fixed cost per unit goes up if the number of units goes down. So, the way to make money is to increase the volume, because then that $48,000 cost gets spread out among more ticket holders. So again, on a total basis, fixed costs stay the same. On a per unit basis, there's an inverse relationship between activities and per unit fixed costs. So as you can see, if there's 2,700 tickets sold, the band costs $48,000. That's $17.78 per ticket to cover the cost of the band. But if the tickets go up to 3,300, the cost of the band is still $48,000, but the per ticket cost becomes $14.55. So the more tickets you sell, the fixed cost gets spread out among increased volume, so the per ticket cost goes down. Variable costs, on the other hand, are costs that increase or decrease in direct proportion to volume. So if the volume goes up, the cost goes up. If the volume goes down, the cost goes down. So in this example here, instead of paying the band $48,000 flat fee, what if the band was paid based on the number of tickets sold? So you tell the band, we'll pay you $16 for each ticket sold. So the more tickets that get sold, the higher the cost of the band. Yeah, so if you tell the band, we'll pay you $16 per ticket, if you sell 2,700 tickets, the cost of the band will be $43,200. But if the number of tickets goes up to $3,300 tickets, still paying them $16 per ticket, so the total cost becomes $52,800. So again, variable costs go up or down in direct proportion to volume or quantities. And here's a table to summarize variable costs. So total variable cost, if the activity or volume increases, the total cost increases. And notice it's proportionately. So that means if, for example, if the volume or the activity doubles, the total variable cost will double. If the volume increases by 25%, the total variable costs will go up by 25%. That's what the proportionately means here. Likewise, if the volume goes down, the total variable costs will go down accordingly. So if the volume or activity is cut in half, the total variable cost will be halved. Okay. On a per unit basis, variable costs remain the same. Okay. But again, in total, it goes up or down in proportion to increase or decreases in activity. Okay, so this example just kind of tells us this is a company that has all fixed cost. This is a company that has all variable cost. And this is a company that has a combination of the two. So notice that they all sell 10 tickets. Selling price is still $10 or is $10 each for all of them. And variable cost per unit, since this company here has no variable cost, it's all fixed cost, variable cost per unit is going to be 0. This company here on the right-hand column, variable cost per unit is $6 because there's no fixed cost, as you can see down here, the 0. This company has a combination of both fixed cost and variable cost. So the all fixed company has no variable costs and only fixed cost. Company in the right column has no variable costs. Has all variable cost and no fixed cost. Company in the middle has both variable and fixed. This is based on 10 units sold, and notice the income is the same for all 4. But let's see what happens when you increase the number of tickets sold. How will that affect each of these companies? So if they sold 11 instead of 10, if it's all fixed company or fixed cost company, they're going to get revenue of $10 each times 11 tickets. That's $110. But remember, the fixed costs didn't change. It remains at $60, as in their previous example. Here, fixed cost was 60 for this fixed company, 30 for the combination, and 0 for the variable company. So here's that 60, 30, 0 fixed cost. So the sales revenue went up, but because this all fixed company has no variable cost, the cost did not go up at all. So they have a profit of net income of $50, whereas the all variable company, because all of their costs are variable, if you sell more tickets, the cost goes up. So the net income is reduced compared to what it was before. What happens if the volume goes down? The volume goes down. There's no impact on the all fixed company because the variable costs don't change. You still have that $60 fixed cost. But now your revenue is 9 tickets sold at $10 each. That's $90. So your net income is $30. On the other hand, the all variable company had no fixed cost. They had 9 tickets sold at $10 each. That's $90. But the variable cost per unit was $6 each. So 9 times 6 is 54. So their income is $36. So as you can see, when the volume went up, it was better to be all fixed. When the volume went down, it was better to be all variable. Okay, that was fixed and variable costs. We're now going to look at a topic called contribution margin approach. So you've seen income statements before in accounting 201, 202, and intermediate accounting as well. The contribution margin approach is just a slightly different formatting of the income statement. So it looks a little bit different. Remember, the traditional income statement was your revenues minus your expenses equals net income. This contribution margin approach income statement rearranges things a little bit. So it's your sales revenue minus your variable costs gives us something called contribution margin. And from that contribution margin, we subtract our fixed cost to get net income. If we were to do a, and I don't believe they have one, but if we were to do a traditional income statement, the net income would turn out to be the same as this contribution margin approach income statement, but numbers are just rearranged differently. Okay, so again, this contribution margin approach income statement, start off with the sales revenue, then you subtract your variable costs, all of your variable costs, to get contribution margin, then you subtract fixed costs to get net income. The traditional income statement, you started with sales revenues, you subtracted cost of goods sold, which is a type of variable cost, to get gross margin, and then you subtracted all of your selling and general administrative expenses to get the net income. So we have a homework assignment that highlights the differences between the two different income statements that you'll have to prepare. Okay, and again, it's the same information, just reformatted differently. Okay, this concept of operating leverage. Operating leverage, the calculation is basically your contribution margin. And again, that was your sales minus all of your variable expenses divided by your net income, 5,000. So we get a number 4. So that operating leverage basically indicates that for every dollar of sales, your profits will go up by 4 times. Okay, so it's a measure of how a percentage change in sales will affect the profits. So if the operating leverage is high, then the change in sales will result in a greater change in profitability. If the operating leverage is low, then increases in sales will not result in very much increase in profits. And we'll talk about that concept when we go over the homework as well. Okay, so relevant range. This is just an assumption that we make when doing analyses that we're going to be seeing in a second. Within a certain range, variable costs, as we said earlier, go up proportionate to changes in volume or increases in volume. Notice that here, this blue line is the variable cost behavior line. It's not really a straight line, but within a certain range, we assume that variable costs are going to be a straight line. Okay, and that's the assumption that we make. Okay. Again, we'll talk about this more later. Excuse me. Okay, so cost averaging, that's a pretty simple concept. Cost averaging is just taking the total cost and dividing by the quantity. So if the total cost is $114 and there's 2 lessons in this case, then it's $57 a lesson. On the other hand, total cost here, $420 divided by the 20 lessons, you get $21 a lesson. So using average costs is, you have to be careful because depends on what level of volume you're talking about. So the average cost really changes as the volume changes. So as it's indicated down here in the yellow, if you're going to use average costs, have to be careful because you have to take into account at what level of volume does this average cost apply. Because as you can see, the average really does change a lot with the changes in activity. Okay, and the final topic in this chapter relates to trying to estimate cost behavior. And let me go back to, oops, sorry, let me go back to, this slide here. Remember that relevant range. Most companies have total costs that include both a fixed portion and a variable portion. So notice here, this line here, red line, if the activity is 0, there's still a cost here. Here's the 0 cost line. But at 0 activity, that red line, there is a positive cost there. That's fixed cost. So a lot of companies, even though if there are no activities and there's no volume, they still have some expenses that they need to pay. That's the fixed cost. And then the variable cost is, as again, the volume of activity increases, the cost then starts to go up. So most companies have what's called mixed cost. Again, that mixed cost has elements of both fixed and variable costs. So looking at this method for trying to determine, oh, sorry, let me go back to that other slide again. So once we have this red line, okay, that is an estimate of all of our costs, our mixed costs, the fixed portion and the variable portion, we can then, if we have this line here, at any level of activity, so let's say right here, whatever that level is, we can go up until it hits the red line and then go across, and then we can find out what the cost is. So by drawing this line here, we can estimate what the cost will be at any level of activity. So let's say, oh yeah, I think our activity level is going to be right here. So we go up and then across. So at that level of activity, our total cost is going to be this much right here. Okay, so again, we want to draw this line so that we can estimate the total cost at any level of activity. So how do we estimate this line? Well, there's two ways of doing it. One is to plot every single data point. So, sorry, I keep going back and forth between these two slides. So for every level of activity that we had in the past, we can plot points, the activity and the related costs. And then we could draw a line through all of those points. But all those points, so historically at certain levels of activity, the dollar amount of the cost at that activity, it's probably not going to be all lined up perfectly so that we can draw a straight line through all of the points. The points may be scattered throughout this graph, which is why it's sometimes called a scatter graph. So our job is to try to find a line that best fits all the data points. One way to do it is to actually do a drawing on a graph. So you plot down all the points and then try to estimate a line through all of those points. Okay, that's called the graph method. That's junk because that's really subjective as far as where the best line is that fits all the points. Okay, that's really, really subjective. So another way to do it is to input every single data point that you have, and Excel has the ability to do that through a function. So you input every single data point, so every single activity and its related costs. You input all of that, and through multiple regression, the computer calculates what the best line through all those data points looks like. That's the most accurate method. Remember, drawing a graph is not very accurate at all. Multiple regression analysis is the most accurate method for determining or estimating a line through a bunch of points, but it's very cumbersome. In Excel, you would have to input every single point, so the volume and the related dollar amount for that point. So if there's 1,000 different data points, you would have to input 1,000 different data points to come up with an estimate of that line. And I'll show you in class actually how to do it really quickly, but that's really time consuming. It takes a lot of time to input all the data points. Again, it's accurate, but it's very, very cumbersome and it takes a lot of time. So a shortcut method is called the high-low method. In the high-low method, okay, we simply take the highest activity level of all of the points on our scatter graph. We take the lowest activity point. So instead of looking at those 1,000 different points, we're only looking at two, the highest point and the lowest point. And we're going to draw a line through the high point and the low point to estimate our line. I think I'll save the actual calculation and the derivation of this final thing we're trying to get is called the cost line or cost formula. The total cost on that graph that we saw earlier, total cost is made up of the fixed cost plus the variable cost. So this high-low method is a method for determining what is the fixed cost and what is the variable cost per unit. And the X is the quantity, so variable cost per unit here is 80 cents times however many quantity there is. Okay. And that will add that variable cost to the fixed cost, and that'll give us an estimate of our total cost. Again, I'll save that for when we go over the homework, but keep in mind the high-low method is a very easy and quick method for estimating that line. It's not as good as the multiple regression analysis, which is very accurate, but it's better than trying to draw a line on a graph, which is very subjective. Okay, so it's kind of like in between. The reason the high-low method is used quite often is because it's easy. You only look at 2 points, the highest point and the lowest point, and the calculations are based on that. And again, we'll go through that in more detail when we do the homework. Okay, so here's an example of that. So there's various points here that we're trying to draw a line through. And notice that they're kind of scattered all over, so it's kind of hard to try to find where an exact line would be. Okay, so again, the multiple regression analyses will take you input every single one of these points into a computer, and then it spits out the best line that best fits all of those points. High-low method, they call it the Scattergraph method, but it's mainly it's mainly referred to as the high-low method. You take the highest point, which happens to be this one here, the one with the highest volume, so the rightmost point. You take the lowest volume, which is the leftmost point right here, and just draw a line through those 2 points. Where this line intersects with the 0 y-axis, that's the fixed cost. So 0, so that's the fixed cost. And then we have to calculate the variable cost in order to, right here, to get our cost line. And again, we'll save the details of that for when we go over the homework. Okay, this is the method that I indicated earlier, the multiple regression method, that uses all of the data points to best draw a line through all of the data points. And here, the goal of this method is to fit a straight line through the data that minimizes the sum of the squares error. So if you remember from your statistics class, what you're trying to do is minimize the error in drawing that line. And let me go back to the previous. So that error is, this line is, see this point is, there's a space between this point and that line that the high-low went through. This point here, for example, there's a big gap. This point here, not so much of a gap. That's what the error basically is. This line here, there's a big error here because this line is not even close to this point. So there's a big error there, smaller error there, but there's an accumulation of all these errors. So the spaces between the points and the high-low line. Multiple regression attempts to measure what the space is. Oops. And it tries to draw a line that minimizes those errors or those spaces between the points and the line. Okay, but the main objective, again, whether using the high-low method or the multiple regression method, is to come up with a cost formula down here in the yellow, where y equals the total cost of something, A is the fixed cost, B is the variable cost per unit, and the X is the volume. Okay, and again, whether we use the high-low method or the regression method, this is what we're trying to achieve. Okay, trying to come up with this cost formula so that we can estimate this y, what's the total cost. Okay, and that's it for chapter 2. And I guess that's it for this time.